Welcome to JivU's platform once again. We shall be discussing another important topic in today's episode of our Forex trading tutorials. If you have not subscribed to this channel, kindly do so now and click the bell icon to get notified when the next video is released. In the Forex market, market movers refer to the factors or events that have the potential to significantly influence the direction and volatility of currency exchange rates. These market movers can range from economic indicators and geopolitical events to central bank policies and unexpected news releases. Understanding these market movers is crucial for Forex traders, as they can impact trading decisions and market sentiment. Here's a detailed explanation of some key Forex market movers. Number 1. Economic indicators. Economic indicators such as gross domestic product, GDP, inflation, consumer price index, CPI, employment data, non-farm payrolls, and manufacturing data, purchasing managers index, PMI, provide insights into the health and performance of a country's economy. Positive or negative surprises in these indicators can lead to fluctuations in currency values, as they affect investor confidence and expectations about interest rates and monetary policy. Number 2, central bank policies. Central banks such as the Federal Reserve, Fed, in the United States, the European Central Bank, ECB, and the Bank of Japan, BOJ, play a significant role in the Forex market through their monetary policy decisions. Interest rate announcements, quantitative easing programs, and forward guidance provided by central banks can impact currency valuations by influencing capital flows, inflation expectations, and yield differentials between currencies. Number 3, geopolitical events. Geopolitical events, including elections, political unrest, trade tensions, and geopolitical conflicts, can have a profound impact on currency markets. Uncertainty and instability resulting from geopolitical developments can lead to risk aversion among investors, causing flight to safety flows into safe haven currencies like the US dollar, Swiss franc, or Japanese yen. Number 4, market sentiment. Market sentiment, often driven by investor psychology, speculation, and herd behavior, can drive short-term fluctuations in currency prices. Factors such as risk appetite, sentiment surveys, positioning data, and technical analysis patterns influence trader behavior and can lead to rapid movements in exchange rates, especially in the absence of fundamental catalysts. Number 5, commodity prices. Currency values of commodity exporting countries such as Australia, Canada, and New Zealand are closely tied to the prices of key commodities like oil, gold, and agricultural products. Changes in commodity prices can impact the terms of trade balances, and overall economic performance, thereby affecting the value of commodity currencies in the Forex market. Number 6, market speculation and news releases. Speculative trading activity and news releases, including corporate earnings reports, central bank speeches, and geopolitical rumors, can trigger short-term volatility and price spikes in the Forex market. Traders closely monitor news wires, economic calendars, and social media platforms for real-time updates and analysis to capitalize on market-moving events. By staying informed about these key market movers and their potential impact on currency markets, Forex traders can make better trading decisions and effectively manage risk in the dynamic market conditions. We shall meet again in the next class. Kindly subscribe to this channel to get notified. Bye for now.